Imagine waking up a decade from now and realizing that the $1,000 you have today could have multiplied several times over. This isn't about luck or gambling. It's about making one smart decision that sets your financial future on a new path. Many people hesitate to invest because they think they need a huge sum or they fear losing money. But what if you could start with just $1,000 and a simple, beginner-friendly plan? Today, we'll break down exactly how to take that first step, avoid common mistakes, and set yourself up for long-term success. Most people never start investing because they believe they need $10,000 or they think investing is just another form of gambling. There's also a real fear of losing money, but the truth is you don't need a fortune to begin. The biggest hurdle is often just taking that first step. Today, we'll show you a simple framework that anyone can follow regardless of experience or background. By the end, you'll see that investing is less about luck and more about discipline, patience, and making informed choices. Let's look at two friends, Alex and Chris. Alex spends every extra dollar living for the moment. Chris, on the other hand, decides to invest a small amount consistently. Fast forward 10 years, Alex is still struggling to save, while Chris has built meaningful wealth not through luck but through discipline and steady investing. This story isn't unique, it's the reality for many. The difference comes down to habits and the decision to start, even with a small amount. Chris's success wasn't about timing the market or picking the next big stock. It was about being consistent, investing a little bit each month, rain or shine. Over time, these small investments added up, and the power of compounding did the rest. This approach is accessible to anyone willing to start and stick with it. Consistency, not luck, is the real secret to building wealth over the long term. Before you invest your first dollar, it's crucial to build an emergency fund. This means setting aside enough cash to cover several months of essential expenses. Why? Because life is unpredictable. If you suddenly face a medical bill, car repair, or job loss, you don't want to be forced to sell your investments at a loss. An emergency fund acts as your financial safety net, giving you peace of mind and the freedom to invest with confidence. Good rule of thumb is to save enough to cover 3 to 6 months of essential expenses. This isn't about hoarding cash but about being prepared for life's surprises. Once your emergency fund is in place, you can invest with less stress, knowing you're protected from unexpected setbacks. This foundation is key to long-term investing success. Now that you're ready to invest, the next step is opening a brokerage account. Look for a beginner-friendly platform with low fees, access to fractional shares, and automatic investing features. These tools make it easy to start small and grow over time. Don't get overwhelmed by choices, focus on simplicity and reliability. The right brokerage can make your investing journey smooth and stress-free. In choosing a brokerage, prioritize low fees, user-friendly interfaces, and features like automatic investing. Fractional shares are especially helpful for beginners, allowing you to invest small amounts in big companies. Take your time to compare options, but don't let analysis paralysis stop you from starting. The most important step is opening your account and making your first deposit. It's tempting to chase the latest hot stock, especially when you hear stories of overnight millionaires. But putting all your money into one trending company is risky. Instead, focus on diversification, spreading your investments across many companies and industries. This reduces risk and gives you a smoother ride even when markets get bumpy. Diversification means not putting all your eggs in one basket. By investing in index funds or ETFs, you automatically own small pieces of hundreds or even thousands of companies. This way, if one company struggles, your overall portfolio is less affected. Diversification is a proven strategy for reducing risk and building wealth steadily over time. Index funds are investment funds that track a specific market index like the S&P 500. When you buy an index fund, you're investing in all the companies in that index at once. This makes it easy to diversify and reduces the need to pick individual stocks. Index funds are popular among beginners and experts alike for their simplicity and effectiveness. ETFs, or exchange-traded funds, are similar to index funds but trade like stocks on the market. They offer instant diversification and can be bought or sold throughout the trading day. ETFs are flexible, low-cost, and a great way for beginners to start investing without picking individual stocks. Let's look at a simple example portfolio. 70% in a broad market ETF, 20% in a technology ETF, and 10% kept as cash reserve. This mix gives you exposure to the overall market, a bit more growth potential from tech, and a safety cushion in cash. Remember, this is just an example, not personalized advice. Your ideal mix may vary based on your goals and risk tolerance. Keeping a small cash reserve in your portfolio helps you handle unexpected expenses without having to sell investments. It also gives you flexibility to take advantage of new opportunities. Cash is not just for emergencies, it's a strategic part of your overall plan. Compound growth is the magic that makes your investments grow faster over time. When you reinvest your returns, you start earning returns on your returns. This snowball effect means that even small, consistent investments can grow into substantial wealth if you give them enough time. The earlier you start, the more powerful compounding becomes. Investing a set amount each month, no matter what the market is doing, is called dollar-cost averaging. This strategy helps you avoid trying to time the market and reduces the impact of short-term ups and downs. Over time, your investments benefit from both market growth and the power of compounding. It's easy to get nervous when markets drop or excited when they soar, but the key to long-term success is staying consistent. Don't let emotions drive your decisions. Stick to your plan, keep investing regularly, and trust the process. Over time, this discipline pays off. One of the biggest mistakes beginners make is investing money they'll need in the next few years. The stock market can be unpredictable in the short term. Only invest money you won't need for at least 5 years. This gives your investments time to recover from any downturns and grow. It's tempting to jump into whatever stock is trending on social media or in the news, but following hype often leads to buying high and selling low. Instead, focus on your long-term plan and ignore the noise. Successful investors stick to their strategy, not the latest fad. When markets drop, it's natural to feel anxious, but selling in a panic locks in your losses and can derail your long-term goals. Remember, market downturns are normal and temporary. Stay calm, trust your plan, and avoid making decisions based on fear. Trying to get rich quick by taking big risks usually leads to disappointment. The most reliable way to build wealth is through steady, consistent investing over time. Avoid schemes that promise fast returns, they're often too good to be true. The world of investing is always changing. Failing to keep learning can leave you behind. Make it a habit to read, watch, or listen to personal finance content regularly. The more you know, the better decisions you'll make for your future. The earlier you start investing, the more time your money has to grow. Consistency is just as important as timing. Even small amounts invested regularly can add up to significant wealth over the years. Don't wait for the perfect moment, start now and keep going. Investing is a marathon, not a sprint. Focus on your long-term goals and avoid getting distracted by short-term market movements. Patience and discipline are your best friends on this journey. Over time, the market rewards those who stay the course. The best investors never stop learning. Make it a habit to read books, watch videos, or listen to podcasts about investing and personal finance. The more you know, the more confident and successful you'll become. Stay curious and keep growing your knowledge. Ready to invest your first $1,000? Start by building your emergency fund, opening a brokerage account, and choosing a diversified portfolio. Remember, you don't need to be an expert to begin. The most important thing is to take action and keep learning along the way. As you invest, review your plan regularly. Make adjustments as your goals or circumstances change, but avoid making changes based on emotions or market noise. A steady, thoughtful approach will serve you best in the long run. Every step you take towards investing is a win. Celebrate your progress no matter how small. Over time, these small victories add up and keep you motivated to stay on track. Remember, building wealth is a journey, not a race. Markets and investing strategies evolve. Stay informed by following reliable sources and updating your knowledge regularly. This helps you make better decisions and adapt to changes in the financial world. Being proactive keeps you ahead. To sum up, investing your first $1,000 doesn't have to be complicated. Build your emergency fund, choose a beginner-friendly brokerage, diversify with index funds or ETFs, and stay consistent. Avoid common mistakes, keep learning, and think long-term. Your future self will thank you for starting today.